we'll need to get to a conversation with the management of Northern Arc, and we'll come back to you. So Northern Arc Capital, the recent listing, it came out with its set of numbers. To understand what's the way ahead from here on, we're joined by Ashish Mehrotra, the MD and CEO of the company. Hi, Ashish. Morning, and good to see you. And as always, what's the outlook from here on? You've declared your past quarter's numbers. That's quarter one. From here on, what kind of a growth are you looking at in terms of AUM, as well as in terms of your margin outlook from here? Let's get both those two questions out of the way first.
Thank you. Very good morning. Nice to be there. We've been consistently growing at over 30% year on year for the last 3 years. Q1 growth is broadly in the same line. Growth on a YOY basis is over 32%, and I think we should be able to hold a similar kind of a growth number. NBFC lending business tends to be a little bit seasonal. Obviously, the H2 is far more stronger on growth than H1. Revenues has grown by over 30%, and profits have actually improved by about 40% on a year-on-year basis. So fundamentally, a strong performance. The credit cost has remained broadly in line. Our GNPA is about 47, 48 basis point. That gives you a context. On a risk-adjusted basis, our NIM, risk-adjusted margin, if one looks at, is actually improved to from 6.9 last year, same time, to about 7.4. So it's a fairly strong franchise. I think we will continue to stay focused in our diversification and ensure we are able to optimize the risk-adjusted return across the focus sectors and ensure the flow of credit to the underserved.
All right, Ashish, couple of more details then, going through your release, there's been a sharp increase in provisions. It's at around 51 crores, but on the lower base, both on a sequential as well as on a year-to-year basis, it's up. Why did this happen? And also your other income is sharply lower. Explain both these two to us.
Two ways of looking at it. Like I said, risk-adjusted return is a better way to look at the metrics. Obviously, our PCR is now, provision coverage ratio is over 74%. We did tweak the model beginning of the year to ensure we have a higher amount of good book provisionings. So that's almost 60 basis point. What you see as a credit cost last year of 120 basis point has gone to 170 basis point. That includes a higher amount of good book provisioning given the stress we are seeing and to ensure there is an overlay sufficient for us. So that's taken us to 170 basis point. After adjusting for that, your risk-adjusted return has actually improved by 50 basis points from 690 to 740. And I think that should provide the sufficient direction in the way we're looking at the continue to grow and optimize the risk-adjusted return. The fee income, like I said, tends to be a little more seasonal. Large amount of placement income as the growth in credit is more driven by festival consumption-led stuff. So it'll be tends to be higher in H2 than on H1. That's one of the reasons why you see marginally lower fee income, but on a year-on-year basis, it is significantly better.
Got it. All right. Also, if you could tell us, on the operating efficiency, I'm looking at your cost-to-income ratio. I think it's at around 55%. A year ago, it was around 50%. On a sequential basis, it compares with around 62%. Where does this number stabilize at?
I think the way to look at it, like I said, your risk-adjusted margin has improved by 50 basis point since we invested in expansion, both in terms of building a very strong tech platform, both for enabling the B2B credit and the customer credit through NPOS and the other technology solutions in data sciences. Our OPEX went up from 380 to about 410. I think OPEX on an overall basis should be at about 4% after we adjust for it. But the margins will continue to happen as we made the jaws are actually expanding. If you look at it, your income is growing faster than expenses, and expenses broadly should stabilize. And we should aim to get higher productivity gains as we look forward.
You want to give us a number? Cost-to-income ratio stabilizes that?
I think we are right now at about 410 basis point. My sense is we should end this year around 400 basis point to my mind. That should hold true. So your jaws will open as your revenue growth will become faster as the balance sheet growth happens and the fee income picks up. And the expenses broadly will continue to get optimized for us to ensure we get productivity gains for all the expansion and investments we've made.
Okay, all right, Ashish, thanks a lot for joining in and filling us in with some color on the past quarter's numbers. We look forward to chatting up with you as this fiscal year does progress.